Good evening. Good evening. Thank you. We still have a few more people trickling in, but I want to be respectful to all of your time on a busy Monday night. So first of all, my name is Neel Kashkari. I am the president of the Federal Reserve Bank of Minneapolis. And on behalf of the bank, we really want to thank you for joining us tonight for this really important session. It's a town hall event where we want to engage with you, members of the public who care about economic policy issues, who care about the issue of too big to fail, and share with you what we're doing, and then importantly, hear feedback from you about what we're doing, what we're not doing, what you would like us to do, what your ideas are. You know, let me back up for a few minutes. And I only want to speak for a few minutes just to set up the discussion. I want to spend most of the time hearing from you and answering your questions and having an open and honest dialogue with you. And one of the things you're going to see about me is I'm very direct. I'm just going to tell you what I think. There are members of the press who are here, but that's okay. You and I are going to have an open and honest conversation, and I'm going to be as candid as I possibly can be and answer your questions in as straightforward a manner as possible. That's my commitment to you. And I just ask you in response if you could show me the same respect and ask me your toughest question. Because if you ask me your toughest question, there's a good chance somebody else has the same question in their heads, and I'd much rather address it than have anybody go home having their questions unanswered. So I joined the Minneapolis Fed. I became president on January 1st of this year, so I'm new to the Twin Cities. I was born and raised in Ohio. I've lived around the country, but I was thrilled to come to the Minneapolis Fed because I care a great deal about public policy. I've seen it firsthand that good, smart public policy can make a big difference in people's lives. Bad public policy can really hurt the country and hurt our communities. So I came here to try to advocate for good public policy on behalf of all of us. Now, if you go back in time a little bit, from 2006 to 2009, I worked at the U.S. Treasury Department. I was first a senior advisor of the Treasury Secretary, and then I was Assistant Secretary of the Treasury. And what I was doing there is I was one of the frontline responders dealing with the terrible financial crisis that we all remember from 2007, 2008, and 2009. In fact, to put a finer point on it, I'm the guy who bailed out the banks. Remember that? The $700 billion TARP program? I was the person who was put in charge of that program. And I got to tell you something, we hated that we had to do that. You know, the Federal Reserve is non-political and non-partisan. I'm not in a political role. I'm not in a partisan role in any way. I worked for a Republican administration, and we were a free market ideological administration. We hated the idea of using taxpayer money to try to stabilize the U.S. economy. But when all the big banks ran into trouble because of the housing downturn, we faced a terrible choice. Either we step in to stabilize those banks, or we allow the economy to collapse. And instead of the Great Recession, we would have been facing the Great Depression. And how did that happen? You know, we had this big housing boom over many years, and we all participated in it, or many of us participated in it. And then when it corrected and it surprised everybody, the banks got caught off guard. And then you think about this. If you injure your arm, you go to your doctor, hopefully your doctor can fix your arm. But chances are that's not going to kill you. But if you have a heart attack, well, that can kill you because the heart is what pumps blood all around your body to all of your major organs. And so a heart attack is really serious. Well, the financial crisis that we had in 2008 and 2009 was like a massive heart attack for the U.S. economy, where we had these giant, too big to fail banks at the center of our financial system and the center of our economy. And if they all collapsed at the same time, it ran the risk of killing the patient. And we had 10% unemployment nationwide. Some regions were worse because of that terrible crisis. We could have been facing the Great Depression, where we had 25 or 30% unemployment. That's how terrible the choice was. And now the good news in that terrible situation is that our political system worked. People of both parties came together, took political risks, did something really courageous and said, we have to act on behalf of the American people and stabilize the economy. And so while I saw one of the worst moments in our nation's economic history, I saw one of the best moments in our political system doing something really tough. You know, it's easy to get politicians to do easy things. It's hard to get politicians to do hard things. And in a moment of crisis, our politicians came together to try to stabilize the U.S. economy. Now, that's what happened in 07, 08, 09. I worked, by the way, for both Presidents Bush and President Obama. Coming out of that, so we stabilized the heart attack. The good news is the patient didn't die. The bad news is if you have a heart attack, you're probably in for a long, hard recovery. And that's what we've been experiencing the last 6 or 7 years. Now, coming out of that, there was strong political interest in making sure that doesn't happen again. I think we can all agree with that. We never want to have that happen again. I certainly feel very strongly about that. So Congress moved very quickly to pass something you may have heard of called the DoddFrank Act. It was a financial reform act to try to make sure the banks are stronger and safer so this type of crisis doesn't happen again. You know, think about all the damage that that crisis inflicted. Even setting aside the taxpayer money that had to go in to support the system, people lost their homes, people lost their jobs, then people who lost their jobs lost their homes. And it was a devastating crisis, literally for millions of Americans, deeply, deeply unfair. So there was strong consensus, let's make sure this doesn't happen again. So Congress passes the DoddFrank Act. Now, I looked at that in 2011, and I was a little bit skeptical. I wasn't sure it really addressed the problems to prevent this type of crisis from happening again. But I said, you know what? I want to reserve judgment, and let's see it get implemented. Let's see what effect it has to see whether or not it really prevented the problem of this type of crisis from happening again. Well, fast forward now. It's now 2016. And unfortunately, as I look at the laws that have been implemented and the regulations, I'm afraid the biggest banks are still too big to fail. The Dodd-Frank Act did some good. I want to be candid with you. It increased the capital requirements for banks. You know what that is? That's the buffer that they keep in reserves, in a sense, for bad things happening, the safety net, in a sense, that they keep. So it increased that. That's a good thing. It increased their liquidity so that they can go access funds if they need it quickly. And it forced them to undergo more stringent exams to make sure that they're not taking undue risks. Those are all positive things. But at the same time, the biggest banks in America are bigger than they were before. The industry is more concentrated than it was before. And so while some good has been done, I'm afraid it hasn't gone far enough. And so my view is now is the time for us to consider more transformational options to solve the too big to fail problem once and for all. So go back in time again, 2010, there's some transformational options that have been talked about. You hear people talk about breaking up the banks, as an example. You've probably heard that. You hear people talk about, you can put so much capital in them, you treat them like a nuclear power plant, like a utility. Nuclear power plants are dangerous. If a nuclear power plant has a meltdown, it's devastating for society. So what do? You regulate the heck out of them so that they're safe and they're sound. Maybe we should treat our big banks like that. Well, these transformational options, in my view, were taken off the table in 2010 because they were so transformational it made people nervous. Well, in my view, it's time we give those transformational options serious consideration. And so one of the things that I'm worried about is that societies tend to forget the lessons that they learned. Right? The big mistakes that led to the Great Depression, we basically repeated them, leading to the Great Recession and the financial crisis in 07, 08, 09. So in my view, we have a narrow window of time, while we still remember how brutal that crisis was, in which to act before we move on and we forget. And so now is the time. And so what we've done here at the Minneapolis Fed, in February I announced this, is we've launched an initiative to look at these transformational options to end too big to fail and give them serious consideration. Now the good news is the Minneapolis Fed has a lot of expertise on this. If you actually go back to the 1970s, this bank's research has been focused on many of these issues, literally going back 30 or 40 years. In fact, one of my colleagues, Ron Feldman, who's our executive vice president here, and one of my predecessors, Gary Stern, wrote a book in 2004, before the financial crisis, saying these too big to fail banks are a real problem and a real risk for society. A lot of people like to claim that they saw the crisis coming, right? Truth is, very few people saw the crisis coming. And people always ask me about The Big Short. I have not seen the movie, but I read the book. I would have been really impressed if Michael Lewis had written the book before the crisis. It's not so hard to write the book after the crisis. Well, Ron Feldman and Gary Stern at the Minneapolis Fed wrote the book before the crisis. So there's a lot of expertise in this bank that we are able to tap into to work on this issue. So today we did something big. We had our first Ending Too Big to Fail Symposium, where we brought experts in from around the country to present their ideas, their transformational ideas. They looked at breaking up the banks as one option. They looked at regulating the banks like utilities, put so much capital in them and regulate them so they virtually can't fail. And we discussed and debated all of the merits and the risks and the pros and cons of those options. And there are other options that we are going to continue to consider. And all of this work that we're going to do this year is going to come together, and we are going to announce or release our recommended plan for addressing too big to fail once and for all. I feel like we have a moral obligation to the country to speak up and to make sure that the public, you, and all of our elected representatives understand the risks that remain today. It's not popular. You know, a lot of people are unhappy that we're doing this. But I feel like we wouldn't be doing our jobs if we were not standing up and talking about the risks that we see. Because at the end of the day, we can't, it's like, think about terrorism. You all know intuitively we cannot eliminate all risk. That's impossible. You're never going to have a system that is risk-free. But it's important that we as the American people understand how much risk we are taking and whether or not we want to add more protection and more safety and more soundness. And so what I'm committed to doing, and all of my colleagues at the Minneapolis Fed are committed to doing, is having an open and honest and transparent process so that all of you, so that the public can see what we're doing, can look at the analysis that we're looking at, can see how we're forming our opinions, and then at the end of the day, we're going to present a plan to you to address too big to fail. And ultimately, you, the public, have to decide, have we done enough or should we do more? So the symposium that we had today, it was completely open. It was live streamed to the web, so anybody could watch and participate. It's recorded. It'll be put onto our website so if people want to go back and look at the discussion. The press corps was there. They're writing articles about it. It's just essential to me. It's essential that we do this in a public way so the public can be part of the process, can understand what we're looking at, because at the end of the day, the public needs to decide whether or not we've done enough. And so my commitment to you is we are going to march forward down this path in an open and honest manner, and we're going to present our best ideas to you by the end of the year. And then I hope we as a country have the courage to do what's necessary to make sure this can't happen again. So that's my wind-up, just framing the discussion to tell you why we're here. I'm grateful that you're here, and we're going to have a lot of Q&A. So we've got microphones that are coming around. If you have questions, if you have comments, if you have feedback, anything at all, please speak up. I'd love to hear from you.
Hi, my name is Eric Mitchellette. Sorry, this is loud. Thank you, Neil. Question for you revolves around your Friday presentation or speech with Minnesota Public Radio. One of the things that never came up was, why not make the officers, key officers of any bank, too large to fail or not, personally unlimited responsibility, unlimited guarantee, in effect, with their full assets, everything, without any way of hiding their assets, so that, because every instrument that comes out, you're going to be chasing it. So they would be personally responsible for their own bank's success or failure.
Yeah, look, I think there's real merit to making sure that management of banks are on the hook for their own actions. There's real merit. And I think the question is, how do we do that? So one of the frustrations I have and many people have, I'll give you an example, is that nobody was prosecuted. You know, I'm not a lawyer. I'm not a prosecutor. This is really the purview of the Department of Justice. It's not for the Federal Reserve. But it's a real frustration of mine and of a lot of people. Nobody was held accountable. And I don't know yet the right way to do that. But I think it's something that we do need to look at. I mean, I'll give you an example, though, just reacting to your initial suggestion. I don't know in any business if you just said all of the employees or all the managers have unlimited liability, if that would work. If you ran a car dealership and you said, okay, you're selling cars and somebody gets in an accident, now they can go after you for your personal assets. I don't know how that would work. But I do think we need to look at corporate governance. We need to look at accountability to make sure that senior executives or financial institutions have the right incentives and are accountable for the actions that they take. Whether it's through some type of penalty or some type of criminal statute, I don't know, but I do agree with the spirit of what you're saying. Thank you for speaking up.
Dennis Dietzler, you've identified the problem as too big to fail. What are your proposed solutions, and what effect would these solutions have on our economy?
Sure. Well, there are 3 that we've identified so far, and there are potentially more. And by the way, too big to fail is just a name. Some institutions might be smaller, but really important. So other people call it too important to fail as an example, but let's just call it too big to fail as an example. So one proposal that's out there is you break them up into smaller entities. Another proposal is you put so much capital in them that they virtually can't fail. So you treat them like that nuclear power plant that I talked about. Another option is one of the problems of all of this is debt in the financial system. Debt is inherently risky. You know, as individuals, if you take on more debt, you're taking on more risk. And let's say you take on a bigger mortgage and then you lose your job. Now all of a sudden you're in a world of hurt. So maybe the issue is not the institution, but it's debt across the financial system. So some people have advocated for taxing debt across the financial system, because right now our tax code puts an advantage for debt over equity, which can lead to more risk. So those are 3 different options. Now, everything has trade-offs. So again, let me go back to the example of airport security as an analogy for a moment. We all know that you can never have an aircraft system, travel system, that's 100% safe. So it's a balancing act. The question is, we could all go through, you go to the airport, you go to Minneapolis, St. Paul Airport, and we could all go through an individual interview. Every time you want to go through security, I'll just take this to the extreme. They could interview you individually, they could x-ray you, they could search your bag by hand. Now what's the downside? It'll take you an hour every time you want to go to the airport just to get through security, and it's going to cost a lot for all of that security, all those security officials. So the cost of travel will go up, and it'll be very inconvenient. So there's a trade-off that we're making. How much safety do we want versus how much inconvenience and how much cost are we willing to endure? The same thing is true in our financial system. We could have a financial system that is virtually not 100% risk-free, but almost risk-free, but then it may result in your mortgage costs more. And so what we have as a society have to decide is how much safety do we want versus how much cost are we willing to endure to accomplish that safety. And I don't have numbers for you yet, but that's the purpose of this effort that we're undertaking now, is to understand what are those levers, how much safety can we get versus how much cost are we going to impose on the economy. And one way of thinking about it, if you were to really increase borrowing costs for homeowners, for student loans, for car loans, we might have slower economic growth. And so at the end of the day, there will be a trade-off. How much safety do you want versus economic growth? And how are those 2 things related? That's where we need to do the work.
I'm Lars Gable, a former employee of this organization here.
Welcome back.
Thank you. And it's nice to be here. I have 2 questions for you.
Yes, sir.
Two observations. Seems to me that a good part of the problem leading up to the crisis was bad real estate loans. And many of those loans were made by people who got commissions for making the loans. They were paid up front and have no responsibility for collecting the loans at some time in the future. And it seems like that could be one place to start, that if you don't get paid for making loans. People ought to be on salary and not commissioned to make the loans. It's just, to me, it's almost like you're inviting poor loans to be created. And the second is just a question for you. What kind of feedback have you been getting from the senior executives of the large banks on your position on too big to fail?
Sure. Well, the first question about the incentives, I think you're right. It's like, in a lot of cases, the complexity of our financial system, people were incentivized to make these mortgages, and then they sold them to somebody else. And the person they sold them to didn't understand the risk that was in the mortgages, and the person who made the loan didn't care because they were passing the risk on to somebody else. And so you're right, these incentive structures, whether it's at the loan officer level, the individual lender, or it's between the investment banks and the commercial banks, these incentives we absolutely have to get right. And importantly, we have to get this right in a way that's going to work over decades. You know, you go back to the Great Depression, huge regulatory reforms came out in the 1930s in response to the Great Depression. But they had never heard of most of the exotic financial securities that exist today because they didn't exist at the time. And so I'm with you. We need to get the incentives right, and we need to try to find a way to protect against big changes that may come 10 years from now, 20 years from now, or 30 years from now. And hopefully we can incorporate all of these ideas in our final proposal. As for the feedback for the big banks, they're not enthused with this process. We invited them to participate because we want all sides to be represented. We think that there are experts at the biggest banks. I personally got on the phone with the heads of the trade groups that represent the biggest banks to invite them and invite their members to come here and participate with us in an open and honest discussion, and they all declined our invitations. And instead, they're out there writing editorials saying, oh, we don't have a seat at the table. It's not fair. Well, they don't have a seat at the table because they turned down the seat at the table. So we're going to continue to invite them. We're going to continue to say they're welcome to participate, but we're not going to allow them to derail our process. Yes, sir.
Neel, Jim Stanzione, thanks for the public appearance. It's good to see bankers can come out in the public like you have. Question, we haven't touched on derivatives. I noticed some of the 4 biggest bank holding companies, which have probably 2,000 to 3,000 subsidiaries that really aren't being looked at. 4 of these biggest banks have over $45 trillion, that's a T, in derivatives holdings. Now, the GDP of the United States is only 15 trillion. GDP of China is about 10 trillion. My question is, why not go back to what solved the problem, as if we don't learn from history, we repeat it. Glass-Steagall, 1933. Now, from 33 to 99, we had no problems. The banks spent something like, the big investment banks, not domestic banks, not commercial banks, spent something like $300,000 per congressional senator and congressperson, $300,000 each to knock down Glass-Steagall. Glass-Steagall is 33 pages. DoddFrank is about 2,300 pages. And by the way, DoddFrank in Section 2, Title 2, has a bail-in clause, not a bail-out. Bail-in means they can come and take your deposits like they did in Italy, Cyprus, and situations like that. I think you have to rein in these big banks, because if you just break them up, they're gonna go around the way they usually do. They're basically too big to scrutinize. Get the Glass-Steagall that separates commercial banking from investment banking. If you're a bank, a commercial bank, you do what the people need: auto loans, home loans, things. If you're an investment bank, you take your $1 trillion investments. You're gonna go to Las Vegas to gamble, because you know you're going to get bailed out, or now with Dodd-Frank you're going to get bailed in. Let's go back to Glass-Steagall.
Well, I think there are a lot of people who advocate that. So just a little more background. After the Great Depression, Glass-Steagall was passed, which was separating investment banking, the riskier activity, from lending, commercial banking. And then in the late 90s, that was repealed. And then all of a sudden you saw these, they called them financial markets or supermarkets, where they had insurance companies and investment banks and commercial banks all wound together. And so a lot of folks have said, why don't we just go back to Glass-Steagall? I have some sympathy for that view, because it will simplify structures of some of these banks. If you look at the root cause of this most recent crisis, in my opinion, it was more about fundamental bad lending, which is people made loans to borrowers who couldn't afford to take out those loans, which in my judgment wasn't so much the marriage of investment banking and commercial banking as much as it was just not understanding the risk that they were taking. Having said that, I don't want to design a solution just based on what the last crisis looked like, because the next crisis is probably going to look different from the last crisis. And so when you think about breaking up the banks, one of the ways people have proposed doing that is returning the Glass-Steagall, so you separate these different activities. Another way of doing it, we heard today in our symposium, is you just put a size cap on the banks, and you say you can only be a certain number of billions of dollars, Instead of $3 trillion, maybe you made it $300 billion, so 1/10 the size, and then they could decide within that size cap what activities they want to have. I see pros and cons to both of those, and these are things that we're going to look at. So I don't want to prejudge and tell you that's the complete solution, but I do think it's worthy of consideration, and a lot of people are proposing it.
So we have an overflow room, and I want to check there if there were any questions coming from the overflow room. Stacy?
Yes, we do, Ron. Here you go.
My name's Jeremy Hudson, and I just want to thank you for having this forum. This is really nice. I'm a technologist to the financial services industry, and I've sort of had a change of heart where I think a lot of what we're talking about here is wrong, because I think the real risk for this industry going forward is a cyber risk. It's a data risk, and it's a cyber risk, because the Fed has been hacked, money has been stolen, and the biggest banks are forced to pay astronomically large amount to protect their assets. It's not fair. The smaller banks, they don't have the money to get the more robust security solutions. So I would like to see your research focus on these things: the cyber risk, the data risk. This is where the future is. All the comments about the past are the past. The future is about security.
Well, thank you for your comments. And by the way, I don't disagree with you. We do think cyber risk is an important risk that all the banking regulators are focused on, because it's the thing that really nobody knows how to quantify, right? We read about it after the fact, after somebody's been hacked, and it is frightening to think of what some really smart hackers, God knows where they are, could do if they were to infiltrate our banking system. And so I agree with you. And there are people around the Federal Reserve System who are looking at this, in addition to other banking regulators, in addition to technology companies, in addition to financial services companies. This is one where I don't think there's much disagreement, that we all agree we need to have as strong defenses as we can. We need to out-innovate the bad guys, because they're working hard to catch up. And so all I can do is agree with you wholeheartedly, but I don't think we should do that and not deal with the other risks as well. I think we need to do both at the same time.
Hi, my name is Paul Gilman. I want to thank you for your service and for having this open forum in this fashion. Others have asked questions that I was thinking of asking you, but let me ask it a slightly different way. You mentioned the effort is focused on too big to fail, and you said there are crimes that were committed, or not to put words in your mouth, but you alluded to that were not brought through the justice system. I'm thinking too big to fail isn't against the law, but that's what your focus is on. What, in your words, how else would you describe where the real problem is? It's not being necessarily too big, but is there another side problem that you would focus on or point to that might parallel your efforts, that you would see as being the real problem that perhaps criminal time should have been spent on, and well, things and fixes that might be associated with those?
Sure. On more of the incentives and the criminal side, fraud has been illegal for a long time. You don't need a new law to make fraud illegal. Fraud's already been illegal. But it seems like a lot of people committed fraud in some of the securities that they were underwriting or that they were selling. Sometimes people knew. You saw in some of the cases where people went through the emails of some of the executives, and they knew that some of the securities that they thought they were going to explode or implode or fail in some capacity, and yet so they were peddling junk. And doesn't seem like there's been any prosecutions. Just last week, I think I read an article in the Wall Street Journal that talked about, so Congress created this commission, the Financial Crisis Inquiry Commission, that investigated what caused the crisis. I didn't know this, but apparently they made several referrals to the Justice Department for bad behavior. And apparently there was no prosecution of any of those referrals. I don't know exactly why that is, but that is something that I think as a nation we need to look at and better understand. And again, we don't need a new law to outlaw fraud. Fraud's been illegal for a long, long time.
Hi, Mark Perman.
Hi, Mark.
We touched on derivatives a little bit, but part of what came out of this was that we were going to make credit default swaps a little more transparent, almost as a marketplace. Where are we at on that?
Right. So that's ongoing. And is Ron here? so my colleague Ron Feldman, who wrote the book Too Big to Fail. Ron, could you help us with where that exactly stands?
Yeah. So, sorry, making a turn around. I apologize for that. So, credit default swaps, the issue there was those are contracts that are written, let's say, between two different firms, and the idea was to have them go through what's called a clearinghouse. I can already sense this answer is getting pretty geeky, but so the main idea was if they go through a clearinghouse, then they're safer. There's more collateral behind them. They're more transparent, and that move's already occurred. And most of the individual credit default swaps are now going through these clearinghouses, and the data is now available to the government, and so they can monitor it and see where there's growing systemic risk between firms. So really, to try to address things that happen with AIG, for example.
Yes, sir.
Hi, Neil. Dean Junkins with Bethel University. So I'm curious, I know the tagline is too big to fail, and you commented that, it might not be always too big. It might be medium-sized organizations. What are you doing to look at really the components of risk, the types of businesses that create the risk for the organization, how much capital is associated with each of those pieces of activities? Because, for example, there's probably no major bank that's going to fail because of oil prices going from 100 to 26, which is a huge problem, right? And there are small banks that are probably going to fail in the oil belt on that. So I'm just curious, what are you doing to sort of look at kind of the key areas of risk in the financial service system?
Well, if you look at some of the good work that has been done and that's ongoing across the Federal Reserve System is something we call stress testing, where we're taking the biggest banks and we're running different scenarios of bad economic outcomes, like a big recession or one of their trading partners runs into big trouble, and seeing can they withstand that. And so in the stress testing, many different scenarios are being looked at to see can they withstand, given their capital structure, given their exposures, can they withstand these various shocks. But the oil example you gave is a great one. And that explains why this is so hard to do. Because I don't know a single person. So we just had the financial crisis in 07, 08, 09. We're all focused on systemic risk and all of these issues. I don't know of a single expert who predicted oil going from 150 to 30 bucks. I don't know of one person who did that. And it just happened. That's a huge economic swing. Now, for many people, it's a good thing, because your gas prices are lower as a result of that. But if you're in an oil producing region or you work for an oil company, that's a really bad thing. So it's a bad shock for some, it's a good shock for some. So that's why whatever we do, we can't count on that we're going to see it coming. We can't count on knowing exactly what the shock is going to look like, because chances are we're not going to know what it's going to look like. So we need to build enough safety and soundness in our banking system so they can withstand any number of shocks that we may not foresee. And that's what we're trying to get to.
Neil, thank you. Welcome to Minneapolis.
Thank you.
We're happy to have you here. And thank you for your service.
Thank you.
Past. Clearly you have rock star status at the airport if you can get through there in an hour. The rest of us, it takes a little longer. But let's say that you do all the work that you're doing here, and that you come up with some really great options. What kind of mandate then do you have to actually implement that, and who needs to approve that?
Well, honestly, in my judgment, some of the things that we may come up with, it's conceivable that the Federal Reserve Board in Washington may have the authority to implement some of it. But my judgment, just looking at the environment that we are all in, is it really is going to be up to the U.S. Congress to decide whether or not to move forward. At the end of the day, these trade-offs between how much risk we're willing to take versus how much we're willing to pay, in a sense, to be safe and sound, what the costs are, that really is a political judgment that the people need to make, all of you need to make through your elected representatives. And so I think what we are going to end up coming up with would require Congress to act, new legislation, to decide once and for all, let's really try to address this issue. So I'm not optimistic that we can implement this ourselves. I think it'll require new legislation. But by the way, that's why we're doing this in as public and transparent a manner as possible. I want us to do our part to inform the public, because at the end of the day, the public needs to make the call.
Neil, my name's Hans Hansen. I was wondering, now you list off three things that you're identifying: the breaking up banks into smaller entities, raising capital levels, and debt tax across the financial system. But the United States isn't just a bubble, and I wonder how you are and your team are going to be addressing the foreign competitive nature of the proposals that you're going to be making.
Sure, thank you. You know, many of the banks, our banks, will argue, well, if you put down tough regulations on us, you're going to put us at a competitive disadvantage to our foreign competitors. My response to that is, too bad. You know, we have to do what's right for our country. And I believe we should come up with one set of rules that we are confident in and apply them to any bank that wants to do business in the United States, and then force them to abide by those rules. And if foreign banks want to then do business here, they have to follow our rules. And so I think, look, we can't control what other countries choose to do with their financial systems and how much risk they choose to take. We should do what's right for America, and then hopefully we can lead the world. You know, in our conversation today, we had our all-day symposium. The president of the St. Louis Fed was here, James Bullard, one of my counterparts. And he said, you know, it's very interesting. When you go to other countries, they don't care about too big to fail. And the funny thing is their banks generally, let's say Europe as an example, are bigger relative to their economy compared to our banks, compared to our economy. It's almost as though European citizens and voters have just accepted that their banks are too big to fail, and it's just a way of life. Well, I don't accept that. If they choose to accept that, that's their call. I don't accept that for us. I think we can do better. Up here.
Hi, I'm Deb Most. I just want to ask you about the role of regulators and the multiple regulatory agencies and how you see that fits into this too big to fail. As my understanding is that there are some things that happen because there were no clear definitions of who goes where and things fell through the cracks.
Yeah, I think there's some truth to that. You know, the biggest banks are all now, one of the things DoddFrank did, the DoddFrank legislation, is it gave the Federal Reserve System, the board in Washington, oversight of the biggest institutions. And that's a good thing. So at least there's some commonality there. But let me tell you something. There's a concept called regulatory capture, where the regulators end up being captured by the bank that they're meant to be supervising, and they end up looking out for that bank rather than really scrutinizing that bank. I saw it firsthand when I was in Washington. I'll tell you how. So we ended up putting capital, investing in hundreds of banks around the country. And for a bank, let's say a bank in Minnesota, to apply for the TARP program, they had to get a recommendation from their regulator. And then that recommendation and their application came to my office at Washington, and we reviewed the application, and we reviewed the recommendation from the regulators. A lot of times, we scratched our heads, and we said, how in the world can this regulator be recommending this bank if we just look at the data? And what we realized is a lot of the regulators, including the Fed, including the FDIC, including the OCC, were captured by the banks they were supervising. And so what we did was we created a council, and we said, okay, this application we're not sure about, so we're going to send it to the council of all 4 regulators, and unless they unanimously send us a recommendation, we're not going to approve it. So we had the regulators checking each other's work. And that's the only way we could really get to the bottom and say, hey, this bank really does deserve government capital or not. So it's a very serious issue. I think for the largest banks, it's a little bit less of an issue because, in theory, the Federal Reserve should have supervision at the top level of that entity. But it is something we have to pay close attention to.
Hi, my name is Bob Grogan. Thank you for the forum.
Thank you.
Conversations, and for the effort. The one technical change that seems most obvious to me and the bad actors that escaped most scrutiny seem like the credit rating agencies. And with your 2 answers, I think it's particularly interesting because it's like American banks aren't too big to fail, they're too creative to fail. And if you don't have some disinterested third party doing that check, then you kind of have this inevitable cycle. And so the change was supposed to be that the credit rating agency was going to be blindly selected rather than paid by the people who wanted a positive rating. What's the thoughts on that?
Yeah, this is one of the vexing issues that has not been solved. You know, we basically have 3 main credit rating agencies, Moody's, Fitch, and Standard & Poor's. And I'm sure there are very good people working there doing their very best. Like everybody else, they really blew it leading up to the crisis, like the regulators, like the banks, like the investors. They really blew it. It's really frustrating that our system, some people have the opposite view, which is just get rid of the rating agencies. And then you won't have this blind faith in these three institutions that are human and prone to error. We have not found a way of extracting them from our financial system and from our investment system. And so this is one where we need to keep working on it. I don't have a good answer for you yet. Let me give you some more context for a second. So let's say you have an employer that has a pension plan. That pension plan may have certain requirements that it can only invest, for example, in AAA securities or AA securities or investment grade securities. That means that pension plan is counting on the rating agency's judgment to be good in making that assessments. Well, that's part of what led us to this, because the rating agencies rated these subprime mortgages AAA, and now all of a sudden these pension plans were investing in subprime mortgages based on the recommendations from the rating agencies. So this is a really complicated, really tough problem that we have not figured out how to solve yet. But I'm with you that it's an important part of the puzzle, and we need to keep working on it. I wish I had a good answer for you, but I don't think we have a good answer yet.
One of the points about the opinions about too big to fail, I think they're too important to fail moving forward. So leading, looking out the windshield, not the rearview mirror, look in there sometimes, but not always. How do we generate wealth and have the big banks drive that? I live in a rural community. TARP's on my four-letter word list.
Sure.
Because regulations really hit small communities very hard. Well, how do we generate wealth throughout the structure? All those people that had the bad loans, they had real good optimistic ideas, but the economy just imploded on them. Jobs went away.
Right.
So then the banks got to blame. And I'm not sticking up for the banks, but how do we see the process moving forward? The process can't be so rigid because the economy is changing. It just changed while we were standing here talking.
Right. Well, I'm with you. One of the downsides, and I'm glad you brought this up, one of the downsides of the changes that have already taken place is that it didn't just affect the biggest banks, it affected all banks. So even small banks in rural areas that weren't part of the problem are ending up living with a much tougher set of rules. And in many cases, they talk to us a lot about how it's impacting their ability to make loans to homeowners or to small businesses or to small farmers, et cetera. So one of my hopes is that if we can have confidence that we've really addressed the risks of the biggest banks, then maybe we can relax some of the burden that the small banks are facing, which could then enable them to get back to lending to small businesses, lending to homeowners, lending to small farmers, to get credit flowing and get the economy moving again.
Thank you. It's really wonderful that you were willing to take questions from the public.
Absolutely.
I'm a little older here. I remember when gypsy cabs were illegal. And you want to do this new regulation right here. How are you going to handle the newfangled mobile banking, other things? Things aren't even banks right now. You can't regulate those. Do you propose expanding your role, or how are you going to handle those things in the future?
Well, I think we're going to have to look at it. There's a lot of innovation going on in the tech sector as they're getting into financial services. And a lot of that innovation is good. It's thinking about just bringing new forms, retail banking or new ways of reaching people. I'll give you an example. I deposit checks now on my iPhone. That's a great innovation that you didn't have a few years ago. That's remarkable. So there's a lot of innovation taking place. We want to keep that good innovation, but we do want to make sure our regulatory system is updating itself to capture some of these new directions the financial system may go, or virtual currencies, or things like Bitcoin. These are things regulators are paying attention to. We don't yet know which of these is going to require new regulations, which of these will fall under the existing regulatory umbrella, but we need to pay close attention. And if we need to make changes, then we need to make changes.
Hi, two-part question. First, as you talk about breaking up the larger banks, if you look to our neighbors to the north, effectively the Canadian banking system had effectively 5 banks versus kind of the thousands that we have here in the U.S. So I guess the first question would just be maybe some comments on that, and they survived the recession significantly better than the U.S. banks here. Second part is, do you foresee any unintended consequences in the commercial lending and capital markets arenas?
Sure. Well, I think that's right. We have to look all around the world in terms of what we can learn from other countries. And so you're right, Canada has a much more concentrated banking sector than we have, bigger banks relative to their economy compared to us. I would guess, I would venture to say that our banks are in the higher risk-taking business than Canadian banks. I think that that's a fair proposition. Whether it's the banking culture is different or the regulations clamp down, even though they're big, they're highly regulated, it clamps down on some of the riskier behavior. I think that we can learn from that and see which of that makes sense to bring back to the U.S. We're not Canada, so it's probably not, we're not going to probably have the exact same system they have, but by all means, we should learn from what's worked well there and see what could make sense for America. In terms of what the consequences could be or the cost to capital markets, again, I think it's things like, here's another thing that big banks will say. They'll say, well, our customers, take General Motors. General Motors probably does business in 100 countries. Don't they need a bank that also does business in 100 countries? And if you were to break up the banks or shrink them, maybe they wouldn't be able to meet General Motors' needs. I don't find that argument compelling because General Motors manages thousands of parts suppliers all around the world. Airbags, brake pads, different electronics. If General Motors can manage 1,000 parts suppliers all around the world, can't they manage a few dozen banking relationships? I think they probably can. I think the treasurer and the CFO of General Motors would figure out how to work with banks all around the world. They don't have to just work with one giant bank. But that's an example of some of the pushback that we will receive if you were to try to restructure the banking sector fundamentally. And again, we need to look at, none of this is free. We need to look at the trade-offs, the costs and benefits. Sir.
Hi, Mr. Kashkari. My name is Chase. I'm here with Bethel University Capital Markets class today. This is actually taking the place of class tomorrow, so thank you for the day off for tomorrow. I really appreciate your analogy in the beginning about the patient with the arm and the heart. And my question for you is, has the problem been fixed with the patient? Is the underlying problem still there? Were the bailouts just masking the problem, and have we really gotten down to the cure for the patient? Going back to your analogy.
Well, it's a tough question. Our economy has not grown nearly as fast as any of us would like coming out of the crisis, but we've done much better than Europe, as an example. So our recovery has been much better than Europe's recovery. So we got some things right. If you look at the history of financial crises, there's a book maybe you and your classmates have already read called This Time is Different by these professors, Rogoff and Reinhardt, who looked at the history of financial crises all around the world. And one of the things that they learned is that when a country has this kind of a debt-induced financial crisis, it takes them 5 to 10 years to crawl their way back out of it. There's a long, hard adjustment process. So many people think we're just undergoing our long, hard adjustment process. Again, just like the recovery of a heart attack, there's really no way to speed it up. You kind of just got to go through your gradual healing process. I think that's partially true, and I think we have to look at everything from regulation to other reasons why our economy may be growing more slowly. There's one theory out there that I have some sympathy with, that we're all a little bit shell-shocked. You go through a crisis like this, and it has scars, psychological scars too, and we're all a little bit more risk-averse. And so businesses, maybe 10 years ago, if they looked at the same market opportunity, maybe they'd be building that new factory. Or maybe you as a homeowner, maybe you're not a homeowner yet, you'd be renovating your house, or you'd be adding on, or you'd be buying that extra car. A lot of consumers are more cautious than they were before. I'm not saying that's a bad thing, but that may be at least part of the explanation for why our economy is growing more slowly, because people are still psychologically recovering from the crisis, not just financially recovering from the crisis.
Hi, Neil. My name's Henry May. Thanks for showing up here. Really appreciate it. I'm wondering a little bit about the timeline for when we can start to see some of these things happen. You talked about 3 alternatives that you've discussed. You've talked about legislation that might need to be introduced to Congress. When can we expect someone to see some of that? And in particular, when could we expect Congress to start debating something like this?
Well, we can control what we can control. So what we've committed to do is to do our analysis over the course of this year, and by the end of the year, come out with our recommended plan. And then it'll be up to the people to decide where it goes from there. And the Federal Reserve is a non-political, non-partisan entity. We don't lobby Congress. I'm not lobbying members of Congress. All we can do is inform the public as best we can, present the options, present the analysis, and then at the end of the day, the people are going to have to act if you want to. We'll do our part, but it's not just up to us.
Good evening. Ron Kirsch. We were talking about the banks and the regulators and the rating industries, and, bad loans were made, and whenever there's a bad loan, you have a lender and a borrower. How do you factor in the process that you're going through on the borrowing side of a loan? What was missing? Why so many bad loans were being made, and how does any change you make or you recommend that gets evaluated in the system factor in for changes on the borrowing side of the transaction?
Well, that was a big part of it. If you go back in American history, there really was almost no time when home prices all around the country fell together. Usually what ended up happening is one region, let's say San Francisco was down, but New York was up, or Miami was up, but Chicago was down. And you had the benefits of diversification because the different markets were uncorrelated. So no one considered that the whole country home prices could go down at the same time. That was probably the most fundamental misunderstanding that we had, whether it's regulators or investors or the rating agencies, et cetera. But some changes have happened. So, I don't know if any of you have tried to get a mortgage lately. I have. It's tough, right? 5 or 10 years ago, no documentation, no income, no job. What do they call it? Ninja loans. No income, no job, no assets. Here's your loan, right? That's over. Now, the question, and that's a good thing that it's over. You have to document your income. You actually have to have a meaningful down payment. That's all very positive. The question is, 10 years from now, or 20 years from now, or 30 years from now, when we all believe, oh, it's different, we've solved all this, we got to make sure that we're not in a position where this happens again. So I'm operating under the assumption that 20 or 30 years from now, we're going to forget. You're going to be able to get that no-doc loan again, and we're going to be convinced it's a good idea. They're going to make bad mistakes, and we're going to be right back where we are. And so we need to make sure the banking system is strong enough to be able to absorb that type of a shock.
Hi, I'm John Walkley. You're on a remarkable journey here. It's just amazing. So perhaps frivolous questions, but did you initiate being on the Charlie Rose show, for example? Did your colleagues know you were going to do that? Did you get the kind of bang you wanted? Is the rest of the Federal Reserve in on it? Are they comfortable? Because you are moving in the rock star era.
Well, so when we announced this in February, we intentionally did this with like a big bang, because my view was I wanted us to trigger a very serious national discussion about these issues. And if we just, economists, I'm not an economist, I pretend like I'm an economist, I'm not an economist, I'm an engineer. People give speeches all the time. And you give a speech, maybe people pay attention for a day, and everybody forgets about it and everybody moves on. This is an issue that's so serious, my view was we need to generate a national conversation, and we need to sustain the conversation so that people cannot ignore us. And the only way I could think of doing that was to come out with a bang, go through all the media channels we possibly could, and reach as many people as we could. And so we've done that. And I can't remember with Charlie Rose whether, David, did we reach out to them? Yeah, we reached out to them, and they were interested in talking about these issues. As for my colleagues around the Federal Reserve System, let's just say there's a diversity of opinions on the matter. I like to joke that once in a while Congress gets it right. And 100 years ago, Congress created the Federal Reserve System. Now, unlike virtually every other country in the world, our central bank is distributed around the country. In other countries, the central bank is just in the capital. But Congress 100 years ago said, no, if we're going to have a central bank, we don't want all the power concentrated in Washington, D.C. We want the power, some of it in Washington, but some of it's spread around the country. So we have 12 Federal Reserve districts, 12 Federal Reserve banks. The Minneapolis Fed is the 9th district, the 9th bank. We represent Minnesota, North and South Dakota, Montana, part of Michigan, part of Wisconsin. And this is why Congress created this distributed system, because they didn't want groupthink just in the nation's capital. And so I feel like what we're doing here in Minneapolis is demonstrating the value, the wisdom of what Congress did 100 years ago. Not everybody agrees with me. Yes.
Good evening.
Hi, good evening.
We've talked a lot about rules and regulations for bigger banks and needing to alleviate unnecessary constraints from smaller community banks. Are you suggesting that those smaller community banks wouldn't need to be held to the same standards as the larger banks? And with that, how are you looking at alternative non-bank lenders and regulating them as well?
Sure. Well, let's just talk about the standards, for example. You could imagine having higher capital requirements for the biggest banks than for a small community bank, because if that big bank were to collapse, it creates huge damage to the economy. If the small bank fails, it's bad for that bank, but it doesn't bring down the whole economy. I'll give you just a separate example, and I'm going to come back to your second part of your question. Think about the tech bubble. Remember the 1990s? Big tech boom, pets.com, all these companies that made no money. Huge boom, and then terrible bust. That was devastating for Silicon Valley. But it didn't bring down the whole American economy. Right? That's what we need in our banking sector. We need our banking sector to be able to make mistakes, but they absorb the mistakes. They don't bring down the whole economy. And that's why if a small bank fails, not so bad. If a big bank fails, it can be very damaging to the U.S. economy. As for the non-banks, so some people call it the shadow banks, we need to pay close attention to those too. So when I use the word banks, too big to fail banks, it really is the too big to fail, the systemic institutions, some of which are very large insurance companies, not just the pure banks. And so that's why if you go back to one of the solutions that people have proposed, where you tax debt in the financial system, that covers banks, it covers non-banks, it covers hedge funds, it covers anybody who uses debt in the financial system. And that's a way of capturing the risk no matter where it goes. Because some people will say, well, if you break up the banks or you treat them like utilities, well, then the risk is just going to move to a hedge fund. Well, we can't have that happen either. So we need to pay attention to all of these different aspects at the same time. Yes, sir.
Thank you. I'm Chuck Hanema from Bethel, and my students are really grateful for your presence tonight. So thank you very much.
Thanks for bringing them.
Quick question about TARP. Given your experiences leading TARP, there's a perception in the marketplace, I think, that TARP costs taxpayers billions of dollars. And recent articles in the Journal, Treasury website, those kinds of things indicate that it's a positive inflow for the government. So would you comment on your perspective of the effectiveness, and given that, would you do it again?
Sure. The TARP made money for the taxpayers. I think the last estimates, I can't remember if it's $10 to $15 billion. Overall, we used Congress authorized $700 billion. We ended up putting out about 425 ballpark, and I think we got back about 440 ballpark. Thank God we ended up making money. Most importantly, we stabilized the crisis. I have to tell you the truth. In the worst moments of the crisis, I did not think we would get $1 back. And we'd have to go to Congress and ask for more. That's how bad the crisis was. So the fact that we stabilized the heart attack and that we got the money back is a miracle. I hope we never have to do it again. It was absolutely the right thing to do, but that's why we're doing what we're doing now, is to make sure that 20 years from now or 50 years from now or 70 years from now, future policymakers are not put in that position again. If they are put in that position again, it's better to do that than to let the economy collapse. But let's not put them in that place. Listen, thank you very much for being here tonight. I really appreciate it.